Hold up! If you click this video, you're probably a new investor or you're new to investing. Or you just thought, who's that good looking guy in the thumbnail? But you definitely came to the right place. You might have heard this random investment stat before. 90% of the people that invest lose money in the stock market. Regardless of how accurate that is or not, many people do make costly mistakes when it comes to investing. This is why today we are going over all the wrong reasons people lose money in the stock market and all the mistakes you should never ever do and should watch out for when it comes to investing. Many of these might seem obvious to you, but this is why they're also easy to overlook and forget, especially if you're new to the investing game. Does that sound good to you? To me as well. So let's get right into it. First reason that you lose money in the stock market is by trying to get rich quick or lacking patience. I hate to break it to you, but the money to be made in investing is in the long term. And unless you get really lucky, you probably won't make that much money in just 1 month. So instead, always try to zoom out from the charts and adopt the mindset of I'm in it for the long term. That way, it will be really hard for you to lose money and you let your investments compound over time by adopting the same strategy as arguably the most successful investor of all time, Warren Buffett. Just ignore these get rich quick schemes and these must-have investment gigs. You should be focused on your long-term investment growth. Next way how you will probably lose money in the stock market is by just blindly following the crowd and not doing enough research. Recently, there has been some crazy stuff going on in the stock market. From GameStop being pumped up to almost $480 to Tesla trading at a price of almost 1,000 times more than what they are making in revenue by selling their cars. These are situations and scenarios you should probably avoid when you're just starting out as an investor. If you're just blindly following the crowd and are not doing any research on your own, you might get extremely lucky, or, which is a lot more likely, you will lose a substantial amount of your money, if not all of it, on these kind of hype stocks. By just blindly following the crowd, you will probably be a little late to the party, and this way you will miss the crazy gains these hype stocks made, and this might have been the reason you invested in the first place. Then on top, if you did not do any research on your investment and you're not convinced of the investment, you will probably panic sell the first time it goes down a little bit in price.
Which is not good.
So just don't do it. Whew! Now that we got the elephant out of the room and I can be sure that you research your investment beforehand, we can talk about this. People can lose money in the stock market by holding onto their losses for too long or taking their profits too early. We all, and especially professionals too, make investments that when we look back didn't pan out the way we wanted to and were a mistake. At a certain point, after some time has passed, it might be the better idea to admit to ourselves that selling this investment is the better idea going forward. That way, for example, you could do something called tax loss harvesting, where by selling your investment at a loss, you do not have to pay as much taxes going forward on the potential gains you made by selling a positive investment of yours. But this leads right into the second part of this point. Try to not take your profits too early if your investment went up in price significantly recently. Up significantly in price recently. Often, if that rapid growth in price of the investment is justified by a unique, innovative business model or a new technology, there's even more long-term growth to come. I, for example, should have done this with Disney stock, for example, which I sold way too early. And many ex-Amazon shareholders are punching the air today because they sold a couple years ago after some crazy gains have been made. And we do not want to talk about the people who sold their bitcoins early and didn't hold on to them. But let me know down in the comments below if you have something that you wish you had never sold. Speaking of Bitcoin, you will lose money by trying to time the market. because it is just impossible to do so. You simply cannot predict what the market will do tomorrow or the day after, but over the long term, you can make an educated guess if you have done some research. Then you can say with a decent probability what might happen. But all in all, there are so many variables, micro factors, macro factors, that you will need to be a god to predict what happens tomorrow or the day after. Here's what Fidelity found when they crunched the numbers on what would happen to a hypothetical $10,000 investment into an S&P 500 index fund from 1980 to 2018 if you miss the best 5 market days. Missing the 5 best days when you're otherwise fully invested drops your overall return by 35%.
No, God!
And the results only get worse the more good market days you miss.
No, God, please, no!
Missing the best 10 days will more than half your long-term returns.
No!
This is why time in the market is advised over the timing of the market. Start to invest now, no matter how high the prices are right now. Hold and ideally buy even more if the prices fall. Eventually, most of your investments, if you did your research, will rise, and we will look back at how cheap the prices then were. Next, and also very important, is to not lose too much money by ignoring fees of investments. Every investment has a cost, even if you don't realize that you're paying for it. There are many different kinds of costs, but they all have one thing in common. If the money is going somewhere else, it's not going to you. Investment costs might not seem like a big deal, but they add up, compounding along with your investment returns. In other words, you just don't lose that tiny amount of fees you paid, you also lose all the growth that money could have made in the future. Imagine you have $100,000 invested. If the account earned 6% a year for the next 25 years and had no costs or fees, you'd end up with about $430,000. If, on the other hand, you paid 2% a year in costs, after 25 years you'd only have about $260,000. That's right, the 2% you paid every year would wipe out almost 40% of your final account value. 2% doesn't sound as small anymore, does it? 2%. Luckily, the fee structure of investment companies and brokerages is improving. But that doesn't mean that there aren't brokers with high or hidden fees. And it's not always our fault when there's so much information to understand about investing. But if you know there are fees and you're doing nothing about it, that's on you for losing money. Because all investments have costs, it might seem like a waste of time to worry about them. Or maybe you assume that a higher price means a higher quality.
Wrong.
Research on mutual funds has shown that higher cost funds generally underperform lower cost funds. There are certainly some things you shouldn't bother worrying about when it comes to investing. But costs are one of the driving factors that dictate whether you'll reach your goal, and they're one of the only factors completely within your control. So please give them the time and attention they deserve. Also, watch out to not lose money by not liking the video and subscribing to the channel. Just kidding, of course, but
please do it.
But seriously now, watch out not to lose money by not diversifying your stock market investments. As you become a more experienced investor, you learn that diversifying your investments is one key to success. And even as a newbie, you'll constantly read about this thing everywhere. By creating an investment portfolio with diversification, you help to protect yourself against stock market corrections, rough economies, or a bear market. The goal with a diversified portfolio is to include various industries and categories that react differently from each other. This way it helps reduce risk, especially long term. Now don't think you won't experience any losses at all, even if you're well diversified, because it happens. But let's take an example. Certain stock funds might have a higher reward, but also a higher risk. If you went all in with that, you might do well during a great bullish market. But as soon as things turn red into a bear market, you can wipe out all returns and potentially more. It's the reason why people mix in vehicles like ETFs, bonds, REITs, cash, real estate, cryptocurrencies, gold, etc. into their investment strategy. Ultimately, what you choose to invest in is based on your investment goals and your time horizon, but try to always be diversified to not lose too much money in the stock market. Last but not least, and a very common mistake, not only for beginners, is losing money by showing too much emotions. Showing your emotions and being human is a great thing.
For more on this topic, check out my other videos and more coming soon.
But with investing, emotions tend to create costly mistakes that drive bad decisions. I personally found this to be one of the most challenging aspects to investing in my first few months of learning. Between the media, stock market fluctuations, others telling you what to do, and your attachment to specific assets or companies, it's hard not to make emotional decisions. But it is a big reason why people lose money in the stock market. Here are some examples of emotional investing so you can watch out for these scenarios. Being too invested in a specific company because you either love their product, you work there, family history of working there, etc. So you base your investment choices on that alone. It actually is a good starting point, but of course there's more to it than just you loving it. Another common one. The market is going up and down and you play into the panic or greed because of what others are telling you. So you sell immediately when a stock goes down, for example.
No bueno.
Similarly, instead of buying low, selling high, you let emotions get the best of you and buy high because there are new records and everyone is excited. Then, when things turn to panic or some corrections set in, you get nervous and sell for a loss when it would have recovered had you held and kept consistently investing. Those are just a few scenarios, but you get the picture. Try to remove emotions from your investment decisions as best as you can. All of the reasons I mentioned in this video, I've been more than guilty of in my early days of investing. But like with most areas in personal finance, you can overcome and correct your ways. So I hope you learned from my mistakes through this video.
You better.
If you enjoyed this content, please let me know by liking the video and why not by subscribing to this channel. I regularly post videos with a lighthearted take on ways to increase your financial IQ, self-development and also lifestyle improvement. Also, please let me know down in the comments below if you have any topics you would like me to make a video on. You can contact me on pretty much all socials at Benny Springer and I hope to see you all over there as well. I truly appreciate the support a lot, and with that being said, I'm out. Peace.
Soon as the snow drop, oh stop, please stop arguing about who's the best MC. I think everyone would agree, they know that you're not.